the Western alliance amongst the people is virtually zero. You will think, I don't want dollars, I want gold. I want real money. And that's why there is now a run on the system. And because gold is real money and all the rest is credit, this is extremely dangerous as far as the mountain of credit is concerned. And a lot of that mountain is in derivatives. I mean, we're talking about hundreds of trillions of positions with counterparty risk in there.
Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
Well, certainly in the over-the-counter derivatives, I mean, it's counterparty to counterparty. When you look at the futures, that's, you've got a central counterparty in the form of COMEX. Is COMEX going to survive this? Well, this is, I think it's a force majeure, maybe in prospect, if this really does deteriorate. And this is where David Webb's book, The Great Taking, comes in, because what happens? I mean, the Great Taking is taking what you think you own in terms of bonds and equities and all the rest of it, registered through a central counterparty, and that central counterparty taking that because they have a prior lien on it, as it were, from the issuers, direct with the issuers, they would take that and use it as collateral, basically, in the event of a market meltdown, credit collapse, whatever, however you like to describe it. Okay, they'll still owe it to you. But you may not quite like the idea of, say, your gold ETF being taken from you and deployed for other things without your permission. I mean, the fact is you don't own it. And not only do you not own it, but also the central counterparty doesn't own it. But they've got a piece of paper that says they can use it as collateral. That is basically where we are. And I think this crisis is really beginning to hot up. I do see higher interest rates as a result of the credit bubble deflating. That will take down capital markets big time. And getting back to what you were saying about, why people just don't understand, the gold is money and all the rest of it. I mean, you look at the mining sector, and the big brokers have spent nothing on researching mines at all. I mean, to them, it's been a dead duck for so long. They've been chasing, cryptos and, NASDAQ stocks and all the rest of it. That's where their research effort really is. Not that research in high tech counts for very much, because that's all momentum stuff rather than value stuff. But you can see that that with nobody really covering the mining stocks, that is why there is so little interest in the mining stocks. That is obviously going to change, and I suspect that with gold going over $2,800, and I think maybe even going over $3,000 in the not too distant future, there's going to be a wake-up call for people who don't have gold, don't have mining stocks, and thinking, what do we, we better, equities are tanking, it's not doing terribly well. My goodness, what do we do with our portfolios? And I think you'll find that investment managers will rebalance, by which I mean they will sell down the momentum stocks and they will look for value elsewhere. And there's one sector which is absolutely screaming out value, and that's the mining sector. And I think that's where they will go. But they've got to be they've got to be scared into selling, the momentum stocks first. And incidentally, I've run charts in the past comparing Bitcoin with NASDAQ. There's absolutely no doubt at all that it's the same cohort in both markets. And when NASDAQ crashes, I mean, I remember, was it in what they call the Great Financial Crisis, which will be minor compared to the one which is potentially ahead of us. I remember how NASDAQ really plummeted. I mean, I can't remember what it was, top to bottom, but I mean, you look at sort of it's 80% or something like that. I mean, and, you know, if that happens again, and it will happen again, and I think it'll be more than 80%, you know, where's your Bitcoin gone? And again, I think that a lot of people have gone into cryptocurrencies as an alternative to gold, and they're going to get a very, very nasty shock. It's just totally the wrong thing to do. I mean, okay, if they banked some, you know, if they banked some of their crypto gains and moved it into gold, I mean, well done them. But most of them will go to bed with this one. You know, they'll lose a lot, basically.
In today's news recap, China foreign reserves increased to $3.2 trillion. China's foreign exchange reserves increased to $3.209 trillion at the end of January. Official data showed Friday after falling in December. The People's Bank of China said that foreign exchange reserves edged slightly higher to $3.209 trillion in January 2025 from $3.202 trillion in December 2024 and above forecasts of $3.2 trillion. The U.S. dollar index fell while global financial asset prices climbed last month, driven by macroeconomic data from major economies as well as monetary policies and expectations of key central banks. The State Administration of Foreign Exchange said in a statement, the country's reserves rose in January due to the combined effects of factors such as currency translation and changes in asset prices, according to the statement. The fundamental conditions and long-term trends underpinning China's economic growth remains strong. These factors will continue to support the stability of China's foreign exchange reserves. The administration said the yuan weakened by 0.7%, while the dollar was little changed against major currencies. Meanwhile, gold reserves were at 73.45 million fine troy ounces, above 73.29 million in the previous month. Their value jumped to $206.53 billion from $193.43 billion, in line with a surge in gold prices.
Yes. It is extraordinary that here we are with gold shooting into new high ground, and the amount of interest in, you know, if you like, the Western alliance amongst the people is virtually zero. It is extraordinary. The interest is all in Asia and associated nations, let's put it that way. I think that part of the problem is that nobody actually understands money. They don't understand that everything is credit other than gold. And we've had 50 years of propaganda from the US Treasury saying that gold is no longer part of the monetary system and the dollar is, you know, is now money, which is pure propaganda. But people tend to believe it. So it's a long, hard battle getting people to understand what is actually going on. You've got the debasement of the currency. To give you an idea of how bad it is in the UK, bear in mind that in 1932, before the second attempt at a gold standard was abandoned, one gold sovereign coin was worth £1, and you could exchange it at the Bank of England for £1. So you take your £1 note and you exchange it at the Bank of England for one sovereign. And you could do that on demand. That was the whole point about the gold standard. So that was 1932. Today, the value of a sovereign is over £540. That gives you an idea about the debasement of sterling credit over the last 90 years. Now, it's a process which is now accelerating. So, and this is an important point. People think, oh, okay, we see prices rising and all the rest of it. Inflation's what? You know, CPI is what, 2.3% or something. I mean, for a start, you can't measure the debasement of a currency that way. The only way you can measure the debasement of a currency is by comparing it with real money, which of course is gold. And we've seen in 2024, we've seen that you know, the purchasing power of the dollar, measured in real money, which is gold, has declined by over 25%. That is an acceleration on the previous year. What we're now seeing, I think, potentially, is a crisis in Western markets whereby the credit system has entered into gold commitments which it cannot deliver. And what that means is that the value of the dollar, the purchasing power of the dollar, is going to decline even more rapidly because people will want out of the dollar and into real money. And then there's a further problem, because as soon as people start really doing that in earnest, you've got all the debt that needs to be rolled over and nobody to buy it. So what happens to the value of that debt? Well, it goes down. In other words, the yield rises. And we are likely to see the yield on the 10-year US Treasury rise through 5% quite quickly. And I suspect it'll be on its way to 10% before very, very long. Now, don't ask me for a time frame on that. But I think the point worth noting is that when it gets through 5%, or if it approaches 5%, and we're 4.6% at the moment, then you're going to see an equity market crash develop. Why? Because we are in the biggest credit bubble seen in history. That is a consequence of going off a gold standard and not allowing successive bubbles to actually properly deflate, wipe out bad credit, bad debts, and all the rest of it, debt being the other side of credit, but just postponing it. Do you remember when we used to say they were kicking the can down the road? We're not saying that anymore because we can't kick it down the road any further. It's not a phrase which is in common.
Don't forget to hit that like button. It really helps out the channel. And if you want to stay updated with more content like this, be sure to subscribe and click the bell icon so you never miss a video.